Andrew, investors have been benefiting from metrics in their portfolios for over a decade now. What is the role private debt plays in an investor portfolio?
I think private debt can play multiple roles in an investor portfolio. At one end of the risk spectrum, I think it really provides a defensive allocation. So it's a defensive allocation to more traditional fixed income alternatives. At the other end of the risk spectrum, when you start going into high yielding senior debt or mezzanine debt, or even debt where the manager's taking equity warrants or taking an equity position, private credit is really an equity market replacement. So moving out of public market equity, allocating into private credit, where you're expecting a higher yield and the ability to participate in potential upside.
One of the key things that differentiates Metrics is you do invest to different parts of the market. Could you explain to us the different types of lending you do and what parts of the market you're currently avoiding?
Look, from our perspective, we look at each individual transaction on its merits, and we look to identify what is the appropriate part of the capital structure that requires financing. And at most of the time, that is for us senior secured debt, the provision of debt, and that's the vast bulk of our funds. However, we also have funds where we do provide mezzanine or subordinated debt, and we also might take equity in certain transactions. So that full part of the capital structure from debt through to equity, I think is quite unique in terms of our product capability. But in terms of the transactions we look for, it's really those that are generating strong cash flows, that have got good sources of debt repayment and debt serviceability. So we tend to stay away from sectors where you've got more volatility in earnings. So sectors like the natural resources sector or agriculture, where you've got more volatility around earnings and cash flow that might impact a company's ability to service and repay its debt.
Andrew, you obviously get unique insights into the real economy being in private markets. What is your outlook for private lending in 2025 and where are you seeing the biggest opportunities?
Yeah, we tend not to be a macro shop. Our business is very much bottom up, looking at the fundamentals of each individual company we lend to. And what we've seen in the past is often, the commentary in the market is backward looking. We've already gone through a lot of the disruption that's been caused as a result of, say, rising construction costs back in 2021. We saw significant supply chain disruptions through that period. We've seen businesses adjust to post-COVID normalisations in terms of demand and supply impacts. We've seen significant cost inflation already flow through the system. But a lot of that is old news. And so what we're looking at is the current market conditions with a forward view. And quite frankly, we think that notwithstanding the significant increases in interest rates that the market has seen, market conditions and demand for corporate credit remains strong. And there are some very strong fundamental drivers that demand that we provide credit into those sectors.